Miami's South Beach area has experienced a major renovation in recent years. Developers are rushing in to scoop up hot properties. One developer launched an ambitious project in the heart of this area to build a fabulous resort hotel, designed to complement a historic Art Deco hotel. The project was financed with corporate bonds. The hotel developer enlists the services of an underwriter to facilitate the sale of their bonds to the public. After the initial underwriting, these bonds may continue to change ownership in the secondary market. The ease with which one can buy or sell a bond after its initial offering is a measure of that bond's liquidity. A firm that is proposing to underwrite the hotel development project is Everins Securities, a bond dealer that ranks among the 10 largest full-service brokerage firms in the U.S. Everins Capital Markets Division serves the market needs of corporations, as well as the interests of investors. Chris Huff manages Everins' bond department.
We're trying to be that matchmaker and link people who are selling securities with people who are wanting to buy them. And again, our job is in the middle of that and trying to find the value for our customers, trying to find the best execution for the sellers and the highest price they can get for their securities, and we're trying to find the best value for the individuals or corporations who may be buying.
In other words, if General Motors wants to raise $100 million for a project, a plant or something, they would call us and we would decide what the interest rate was going to be, what the maturity along with GMAC, and then we buy them into our inventory and take the risk of reselling.
Most people are much more familiar with stocks than bonds, yet the value of U.S. stocks and bonds are almost equal. Bonds just don't attract as much attention because the stories behind stocks are easier to follow. Compared to stocks, bonds rarely make news. A bond is basically a loan, or rather the long-term debt of the issuer. The issuer promises to return the face amount, or par value at maturity. Typically, the issuer is also liable for regular interest payments. Bonds are the most senior debt, and are the first debt repaid in case of bankruptcy. Conversely, a share of stock represents an equity, or ownership right in a corporation, as well as a share of the corporation's earnings. Stocks have the least seniority and are the last to be paid if the business fails. The South Beach hotel developer recently issued $83 million worth of bonds to finance the hotel construction. The hotel developer issued the bonds in standard $1,000 denominations, which will mature in 6 years when the developer plans to sell or refinance the hotel. The bondholder will be paid interest, known as coupon payments, each year for 5 years, and in the 6th year, both interest and principal will be paid. The hotel developer gets a tax deduction for the interest expense and a better interest rate than they would on a loan through a bank. There are 3 distinct differences between stocks and bonds. When issuing stock, the ownership of the company is shared with the new stockholder. When bonds are used, no ownership is granted to the bondholder. Dividends paid to stockholders are not tax deductible. Interest paid to bondholders is an allowable deduction. The amount of dividend paid, if any, is at the discretion of the corporation issuing the stock, whereas bondholders must be paid the coupon amount at the designated disbursement dates. The hotel developer had to be concerned with interest rates. When interest rates rise, bond prices fall. The hotel developer offered fixed-rate bonds. So, if market interest rates increase after the bond sale, the bond investors would receive less than face value if they had to sell prior to maturity. Take, for example, a $1,000 par value bond maturing in 10 years with $50 or 5% annual coupon payments. If market rates quickly increase to 6%, the $1,000 bond would be discounted by the market to $833, making the $50 coupon yield 6%. Bond prices are also affected by bond ratings, a measure of credit quality. The higher the credit quality, the higher the bond rating, and the lower the interest rate. A change in the hotel developer's bond rating will affect the interest paid on the bond issue, and ultimately the profitability of the new hotel. A department store chain may need to borrow money in the bond market as well. But suppose their needs are just for a few months to manage the expense of carrying a large inventory of Christmas merchandise. They would be likely to issue commercial paper rather than bonds. Commercial paper is the short-term, usually unsecured debt of large and well-known companies. This is frequently issued with maturities of less than 2 months. Because there is little active secondary trading in commercial paper, it has low marketability. Therefore, it is an appropriate investment for a firm that plans to hold it until maturity. In this case, commercial paper can make the holiday season a little merrier for large retailers.
You see retailers who are doing seasonal funding of their inventory and don't need to borrow for a long term, but maybe 30 to 90 days, who come in and issue commercial paper. As they sell their receivables or their product, they can very quickly pay the commercial paper lines down. Commercial paper is very short dated. You can almost always buy the maturity that you are looking for, and you're going to receive a little higher yield than you would in either a bank deposit or a CD or treasury bills.
The U.S. government is the most prolific issuer of bonds. Government treasury bonds are very popular among investors because of their relatively low risk and high liquidity. Treasury bonds are initially issued through Federal Reserve auctions. These auctions establish the interest rate the government will pay to borrow the money it needs. Traders like Ham Davis and Ted Ake study these auctions, as well as shifting prices of older bonds and economic indicators in an effort to predict how the market will move.
One reason that people are involved in the Treasury note or the Treasury bill or Treasury bond market is that it is the deepest, most liquid market in the world for debt securities. They are the benchmark for the world's risk-free rates of return. When people try to analyze a project and look at the risk-free rate of return, they start with Treasury note yields. It's good for people that are very risk-averse. If you want to make sure you're going to get your money back, be in the Treasury market.
The other positive factor about treasuries is the liquidity factor. Because there are so many of them out there, there is a very liquid secondary market that these securities can be bought and sold with a very tight spread at any time of the day or night. And so that kind of liquidity has been a huge factor as to why the entire world likes to invest in treasuries. They can get in, they can get out very quickly.
People who are buying bonds can generally be categorized as investors and traders. Investors generally will buy bonds to hold till maturity, while traders typically look for a short-term profit.
When people ask what's our market in comparison to, say, the markets that they see on TV when they're looking at the bond pits and you see people screaming and shouting all crowded together, how's our market different than that? In many ways, it's actually quite similar. We are establishing prices for securities. The only thing is we're doing it over a phone network, a computer network, and we're buying and selling securities in the cash market as opposed to the futures market.
The shorthand language of the bond business may sound foreign or extremely technical to the layman.
Ted, can you bid 5 tens?
Pay you 101.25.
A 101.25. Okay? Okay, that's done if you're still there.
Okay, you're done. I bought 5 at 101.25. Thank you.
Okay, you're done at 25. All right, thank you. The side that I did on the trade is I had a customer call. They wanted to sell out of some 10-year treasuries that they had owned for a while. At this point, they were trying to get in and use the money to buy equities. So they wanted to sell. They thought the market had reached a high point for the day. So they were asking for a bid on the treasury. So we bought the 5 10-years at a 101.25.
That's 101 and 25 30-seconds. It's roughly worth about $5.1 million, including the accrued interest. After we did the trade, I went and turned around and sold them out to the street. Our customers will sell to us just as often as they'll be buying from us. We stand here to make a liquid secondary market, which means we stand ready to make both a buy side and a sell side at any particular time.
Although bonds are underappreciated by the layman, as well as many stock market investors, they're the cornerstones of long-term financing in capital markets. Investing in bonds is basically investing in debt, and the value of the debt varies according to interest rates and the credit worthiness of the borrowers. Bonds have a wide variety of applications, from financing a resort hotel with corporate bonds, to investing a corporation's pension funds in treasury notes, to financing a department store's Christmas merchandise with commercial paper. They may not be exciting, but bonds play a major role in financing our economy. Their versatility and tax advantages make bonds a favorite tool for the largest borrowers in the world.